Okay. So once again, I want to welcome those who are just joining us for the first time to the advanced taxation class. And before now, we have addressed some topics that we also had in our syllabus. So we have dealt with the introduction to the taxation, then we where we discussed about the national tax policy of 2017, and then we have also discussed about the basis period that has to do with the abnormal basis period, where we have the commencement rule, we have the decision rule, and then the change of accounting dates. So today we are going to be discussing about the computation of the adjusted profits or loss in the taxation. So that is what we'll be dealing with today. So I'll be sharing my screen, and please let me know if you can see my screen at your hand. So kindly confirm if you can see my screen.
Yes,
Okay,
I
yeah,
can see your.
thank you. Okay, yeah, thank you. So
Yes.
before we, yeah, thanks. So before we start the class, I don't know if maybe any of you has one or two questions. So before we deep dive into today's topic.
No question. No question.
Okay, from your end. Okay, yeah, thank you. So in the absence of comments, so let's start. The ascertainment of adjusted profit or loss. Let me put loss there. So why this topic is very essential for us is that there is difference between accounting profit and taxable profit. So the profits could be classified into two. We have taxable profits, and then we have accounting profit. So when it comes to accounting profits, we prepare our accounting profit or loss. Let me say profit or loss, okay? So we have taxable profit or loss. So, or we also have accounting profit or loss. So when it comes to accounting profits, we prepare our accounting profits using IFRS accounting standard, isn't it? Please, I want this class to be interactive. So we prepare our
Yes,
accounting
sir.
profits based on IFRS accounting standards, and our taxable profits is being prepared based on our what? Based on our tax laws. Are you getting my point now? So when it comes to our IFRS accounting standards, there are some provision of accounting standards that is not acceptable under the tax law. And the reason is not far-fetched. One of it is depreciation. You may see two different companies that are working, or that mean that are operating in the same industry. These two companies may also purchase an asset at the same time. They are operating at the same level, but don't be surprised, they may have different depreciation policy and then the depreciation estimates. Are you getting my point now? So because of this, if company A, if company A has a motor vehicle that's worth 5 million naira, and company B has a motor vehicle that also costs 5 million naira. Please give me 2 seconds. And company B also has a motor vehicle that's worth 5 million naira. So company A may decide that its useful life of his assets of this motor vehicle is, let's say, 5 years. Why company B may decide that his useful life of his own motor vehicle could be 4 years. So, invariably, if both of them are preparing their financial statements, their depreciation rates will be what? It will be differ, isn't it? Because in the first year, which as in during the useful life of the assets, the depreciation that company A will charge will be lower than what company B will also charge. When it is now time for them to prepare their taxable profits, the depreciation that will be charged by this company will also be lower, which means the company income tax for company A might be higher than what the company B will be reporting as its own taxable income. So, because of these differences, the tax authority now come up with a law or that no, we cannot accept a situation where the same type of assets that are being used by two different companies will be charged using different rates or using different accounting policy. Company A may even decide that it wants to be using straight line method to compute its own depreciation, while company B may decide to be using reducing balance method. Even if two of them are still using the same useful life for their assets, at the end of the day, they will still result at different depreciation amounts. So that is one of the reasons why the taxman will never adopt the accounting profits to to be charged using the tax rate, right, as the tax paid during the accounting. But what are we now capital allowance depreciation? We have what is called capital allowance in lieu of the depreciation. Every company can adopt a uniform rate when it comes to the part applying depreciation. Currently, depreciation is not allowed when computation of adjusted profits, but capital allowance, all the companies will use the same capital allowance rates. That is just why the accounting profits a basis to compute our tax, but it starts as the foundational profit. It starts, it is used as what we are going to leverage on, but just that it is not, the profit is not what will be adopted to be computed tax by the company. So that is just an overview of this. So let me explain all this. So on the notes, we have the corporate income taxes determine the true profit of a business. That is what the taxation is all about. We want to determine how much a company will be assessed to tax. Why the financial accounting is prepared, generally accepted accounting principle, as earlier explained. When profit is prepared and adjusted to that accounting profit at the taxable profits using the relevant. So these adjustments are basically four categories. We have the salariable expenses. So the salariable expenses are charged in the profits or loss, right? But not deductible for tax purpose. One of them is depreciation. Then we also have chargeable income omitted. This relates to the income not credited in the statement of profit or loss, but it is also taxable. There might be some times whereby the income that are generated by a company might be mistakenly omitted. It may not be purposely omitted, but mistakenly omitted. So, whenever we have such type of income, we need to make an adjustment to the to the accounting profits that has generated such profits. Then we also have non-chargeable income included. Income credited in the statement of profit or loss, but not taxable. For instance, we have frank investment income, which is dividend. Then allowable expenses omitted. So whenever we also have deductible expenses that are not charged in the profit or loss accounts, so we also need to adjust for it. So now let us now address the principle that will make us to understand what is allowable and not allowable. So for the allowable expenses, an expense is deductible if it satisfied these four. Only that expenses must be only spent, only it must be reasonably, it must be exclusively and necessarily incurred for the business. So if an expense does not satisfy all these four conditions, such expense will be disallowed. It will not be allowed for tax purpose. And how do we consider that an expense satisfy rent principle? Number one, such expenses must be only spent for the business, which means you cannot bring in personal expense into the business and think that you are going to use that one to reduce your tax. It will not be acceptable. It must also be exclusively, purposely for that business. What we are saying here is that you cannot bring an expense from another business and bring it into your own business that you want to use it to complete your taxable profit. It will not be acceptable. It must also be necessarily. So if an expense is not necessary to be incurred, it will also be disallowed. And then it must also be reasonably enough. So you see, all these four principles that we have listed here, it is sometimes at the discretion of the taxman, because there may be some instance whereby you will incur some expenses and the taxman will tell you that they are not going to accept it, that it is not reasonably or it is not necessarily for the business. But it also now depends on how a business can defend such expense, that these are actually satisfy the rent principle so that it can be allowed. So what are the allowable expenses that could be accepted in order to arrive at the taxable profits? Number one, we have interests on debt borrowed for capital to acquire profits. So if you incurred interests on the loan that you have borrowed. Let us take, for instance, that you borrowed funds to acquire machine, and that machine will be used in production of your goods that will be meant for resale. So such interest that might be accrued on that type of loan will be allowed to be deducted for your tax purpose. Rents and premiums on land or building used for generating profits is also allowed. So what we are saying here is that it is not every rent that you incur that will be allowed for tax purpose, or that will be allowed for deduction for your tax purpose. So if that rent is not incurred in order to generate profits, it will also not be allowed for deduction. Repairs and renewal costs for business premises, plants and fixtures. So when you also have repairs for whether your plants, your fixtures, for your items of, as I mean, for the items of asset that you have in the business activities, it will also be allowed. However, the cost that increase an asset earnings capacity will not be allowed as a deductible expense. What we are saying here is that, under your IAS 16, we have a situation whereby you can capitalize your expense, right? So, and one of these expenses that if you incur an expense that will increase the capacity of that asset, right? So it can be capitalized. So what they are now telling us here is that if you incur such expense should rather be capitalized to your assets, but it should not be what? It should not be deducted as an expense. So if you deduct such, the taxman will ask you to remove it, that is not an allowable expense. So that is what we are saying here. So any expense that you incur that is of capital in nature, you may do some repairs, but if that repairs, or maybe you are doing an overhauling of of an asset, and if that overhauling has to do with a capital expense in nature, you will not be allowed to take it as an allowable expense. Bad debts and doubtful debts, but it must be what? It must be specific to a trade or a business trade or a business debt. So if you have any general reserve, or you just have general debts, it will not be allowed. So your bad debts must be specific in nature. Contributions to approved pension, provident, or retirement schemes, whether you are doing defined benefit contribution, and whether you are doing defined benefits or you are doing defined contribution. So any cost that you incurred under these two programs is allowed. Then salaries and wages or other remunerations paid to employees will also be considered to be an allowable expense. Research and development expense. 20% investment tax credit is also available for qualifying research and development expenditure incurred for commercialization. So when you are carrying out research and development activities, And such research and development activities will be commercialized at a future date. So it will be deductible. But just that such research and development is capped at 10% of profits before your what before your R&D or your donation. So that is what we have as specified in our tax law. Then the dividends or mandatory distributions from a real estate investment company approved by the SEC is also allowed, while the compensating payments in a regulated securities lending transaction. So I've also explained this in one of our classes. So when you have a regulated securities lending transaction whereby you borrowed money, whereby you borrowed shares from someone, while another person also, while you also give cash in consideration of the shares that you borrow, just that you will need to return that shares. But whatever cost that you incurred in that regulated security lending transactions would be allowed for tax deductible. Then our donation is also allowed if you are in a business and you donated any money to any organization, to some specified organization, not just any organization, to some specified organizations, you will also be allowed to have a tax deductible. But this donation must satisfy with these conditions before you will be allowed to deduct donation as part of your tax deductible. Number one, a company that wants to donate must make that donation out of the profit, which means a company must not be in a loss position and still consider that they want to deduct, that they want to give donation. So if such company provide donation and is in a loss position, that donation will be disallowed. Then it must not also be of a capital nature. Then should also be limited to 10% of the profits before donation could be deducted. It must also be made to an approved body listed in the fifth schedule. So we are going to see all those bodies that are listed. Then a notable exception exists for donations to university or other tertiary institutions for research or development purpose. These are allowed up to 15% or 15% of total profit or 25% of tax payable, whichever is higher. What you are saying here is that before you can be allowed to donate to whether tertiary institutions, that donation must not be more than 15% of your total profits or 25% of the tax that you are supposed to pay. The donation is supposed to be capped at 10%, but then there is an exception for tertiary institution when you are making a donation to tertiary institution or to a research institute. So where you have such case, you can be allowed to donate up to 15% of your total profits or 25% of the tax that you are supposed to pay to the government. But whichever that is higher between these 15%, which means if your 15% of your profits, of your total profits is, let's say, if total profit is 50,000, then the 15% of this is what will be allowed. Or if our tax payable is, let's say that one is 20,000, Then you calculate 25% of this. So whichever is higher is what would be allowed as tax deductible. So the following are the approved bodies and institutions in Nigeria to which donations may be made under Section 21. We have youth and philanthropic organizations. So under youth and philanthropic organizations, these institutions, this body are grouped under the youth and philanthropic organizations. We have Boys Brigade, Boy Scouts, Girls Guide, Nigerian Red Cross, and National Youth Council of Nigeria, then the Nigerian Youth Trusts. So any donations that we are making to all these bodies should not be more than 10%. So that is, if anything above 10% will be disallowed. Anything above 10% will be disallowed. We also have religious body. We have Christian Council of Nigeria, and we also have Islamic Education Trust. Then for medical,
Sorry, 10% of what? Sorry.
we have, it is 10% of the total profits before the donation will be deducted. So this is what we are saying here.
Okay.
If your profits is 20,000, you know that before you arrive at this profit, you must have initially deducted your donation, isn't it? And your donation is, let's say, 2,000, right? So what we are now saying here is that profit before donation would be how much? Would be 22,000. Are you getting it now? So if you now calculate 10%, of this amount, are you getting? So 10% of this 22,000 will be 2,002. So it means that you are still within what? You are still within the threshold. Are you getting the gist now? It means you are still within the threshold. But if the donation that you are giving, right? If the donation that you are giving is, let's say, 5,000, if your donation that you have awarded was 5,000, and your total profit is what? Your total profit is 20,000. Are you getting it? But the donation that you have given here is 5,000. The profit before donation is out. Okay, let me just hold on. So let us assume that your total profit is 20,000, which means this is profit after donation, because you must have given your donation before you arrive at your profit, right? Profit after donation. But you gave a donation of 5,000. So your profit before donation will be how much?
25,000.
Exactly. Profit before donation will be 25,000. And 10% of this, 10% of profits before donation is how much?
Yes, 25.
2005. So which means the excess will be what? To be disallowed.
Disallowed. Okay, disallowable.
Yes, it's going to be disallowed. So only 2005 will be allowed as tax
Okay.
deductible. Is it clear now?
It's clear. It's clear.
Okay. Yeah. But in a case of tertiary institution, you are allowed to give up to 15% of your what? Of your taxable profits, of your total profits, or the tax that we pay. So if you have to charge, but if it is going to be if it's going to be on the tax payable, it has to be 25%. So anything above that 25%, it should be what? It should be disallowed. So this is what we are saying here. Then for medical, any hospital owned by federal government or state government, including all the university teaching hospitals, or hospital operated by a society or association not established for the purpose of generating profits or distributing gains to individual members is exempt from taxation. So what we are saying here is that if you have an hospital, we are not talking about a private hospital now, but we are talking about a government hospital, including all these teaching hospitals, whether Olabisi Onabanjo University Teaching Hospital, University of Maiduguri Teaching Hospital, all those teaching hospitals. Or we also have an association that has an hospital just to be providing charity for people. So any profit that they generate will be tax exempt, provided that profit will not be distributed to the members of those hospitals. It's not that maybe they cannot pay salary, they definitely pay salary, but whatever is left after their operational activities as a profit will be exempted. It will not be a tax, it will not be taxable. Therefore, education, any educational institution affiliated under law with university in Nigeria or established under any law in Nigeria and any other educational institution recognized by government. For instance, all these professional bodies that we have, their profit are also tax exempt. The Institute of Medical Laboratory Technology, the National Library, a public fund established and maintained exclusively for providing money for the acquisition, construction, maintenance on or equipping a building to be used as a school or college by the government. So when you have a public fund that is established, sometimes a government may set up a fund that, okay, we want to get a fund to maintain, or we want to acquire schools, or we want to construct schools. So any gain that is made from such fund is also not taxable, provided that gain is meant to cater for the construction and maintenance of such building. Then we also have National Braille Library of Nigeria, Van Lee. So we have all these institutions that are, all these bodies that are listed in the tax act, that whatever profit that they made will be exempted. Or if we also donate to any of these bodies, because all the majority of these bodies are established by an act. So any donation that we make to this body will be exempted. So they will be tax deductible rather. So what are our disallowable expenses? Section 23 of company income tax specifically lists expenditure that are not deductible, even if they are charged in the profit or loss. So they must be added back to the accounting profits. Examples are capital repayments or withdrawals and any expenditure of a capital nature. Now, this is what we are saying. You obtain loan. When you obtain a loan, a loan that you obtain a loan from another party. So when you are paying, there is going to be interest on this loan. You have interest, and then you also have capital repayments, which is the principal. So what the law is now saying is that if you repay any capital, you cannot come and take it to your expense. You cannot come and bring it to your expense and say that you want to deduct it from your profit. On a normal, even when you are preparing your profit or loss accounts, someone made a mistake and say, okay, whatever loan that I'm repaying should be credits should be debited to my profit or loss. But on a normal day, your loan, your principal loan is not expected to pass through your profit or loss account at all. It's not expected to pass through your profit or loss account, but it's an item of what? Of your statements of financial position. Are you getting it now? So if it is an item of financial position, so any change in this or any movement in your principal repayment should also pass through your statement of financial position. So if you now made a mistake and took it to your profit or loss account, it will be deducted. I hope this clears now. So capital repayment or withdrawal and any expenditure of capital nature is not going to be allowed. So it's rather be treated as a salary expense. Taxes on income or profit. If you pay tax on your income, you cannot consider this to be an allowable expense. Depreciation of any assets, either depreciation or amortization, it will be what? It will also be, it's allowed. Appropriations of profits, such as dividend and general provisions. So, your profits, when you are appropriating profits, when you are paying your profits. So, let me ask, maybe for those of us who are preparing for CR or for someone who has even passed CR, I'm sure all of us must have even passed through our FR before coming for this class. So if a company is making payment for dividend, if you want to deduct your dividend, where do we take it to? Where do we take our dividend to? Please, I need an answer. Where do we take our dividend to? If anytime a company wants to deduct a dividend from its profits, where do we take it to?
Other comprehensive income.
No. Any other
Retained
attempts?
earnings, no.
Exactly. We take it to retained
So
earnings.
retained earnings.
Yes, thank you. And our retained earnings is reported to where? Is reported to statements of changes, right? Statement
Equity.
of changes in equity. So which means whatever dividend you are paying, you don't also take it to your profit or loss. That is IS1 for you. So that is why it will also be treated as a disallowable expense. Some companies might declare dividend. So when they are now declaring that dividend, they will now consider that, okay, since I've declared dividend, so let us also take it to expense, because it's an expense to us. No, you rather take it to the retained earnings. So we also have general provisions for bad and doubtful debts. Expenses related to tax exempt income. If an expense relates to both tax exempts and non-exempt income, only portion corresponding to the taxable income is deductible. So what we are saying here is that if you have an expense that you incurred an expense, and when you incurred an expense, such expenses is only to generate non-taxable income. Okay, let me give you an example here. Let me cite an example here. So you have your property, plant, and equipment that you want to dispose. So you have your property, plant, and equipment. Property, plants, and equipment that you want to dispose. But when you are disposing it, you take it to your what? You take it to the you are going to report it under IFRS 5, right? So as in disposal assets. So now, don't forget that you might also likely incur some expense. Let's say your marketing expense. You incur some marketing expense. Maybe you also incur some commission. So what you are now saying here is that if at the end of the day you dispose these assets, you now make profits from this asset. This expense that you incur, right, will not be allowed to be deducted for tax purpose. I hope you are getting this. So this expense, you have already made a profit because the profit that you even made from this property, plant, and equipment is a non-tax, is a non-taxable profit. Hmm? Are you getting my point now, Bob? Because you are going to account for it under capital gain tax. So you don't, but it's part of your non-taxable profits here. So that is why whatever expenses that you also incurred will also not be accepted as your taxable, as an allowable expenses. I hope you are getting it. So that is what we mean here. Tax expenses related to tax exempt income is also disallowed. Penalties imposed by any statute, if there is any penalty that is imposed by any legislation, maybe from your tax or from any infractions, it will not be allowed. It's not only from the tax that you incur penalty. For instance, if you did not file your financial statements as and when due with, let's say, Securities and Exchange Commission, you will be what? You will be penalized. So, and such penalty will be disallowed for tax purpose. So, tax or penalty borne by a company on behalf of another person, then expenses involving related parties that are inconsistent with transfer pricing regulations, so will not also be allowed. Any question thus far?
Sure. No.
Okay, yeah. Then we have an interest expense deductibility. So if you incur an interest expense in the course of your business transactions, how will such interest be treated? Section 24 of SITA. Okay, I need to quickly address something. Please, when you are answering any question, if you are not sure of that section of the law, please do not quote that section. If you are not sure of the section, you can just say that section of the Tax Act. Are you getting it now? Because if you go and quote wrong section, whatever item, whatever responses that you have given there will be penalized. The examiner might even mark it wrong. So it is better you don't even quote any section. You can just say, okay, maybe according to the relevant section of the Tax Act, then you can now continue. So that is just to bring that to your attention. So section 24 of SITA and seventh schedule introduce a restriction on deductibility of interest paid to a foreign connected person. The excess interest defined as the amount of total interest paid that exceed 30% of earnings before interest, taxes, depreciation, and amortization is a disallowable deduction. So what we are saying here is that, sorry. So what we are saying here is that if you have a connected person could be in form of transfer pricing, where you also have some other entities under common control. Are you getting it now? So if you have some subsidiaries that are in the same group, will be considered as a connected person. Now you have ABC Nigeria Limited, and this ABC Nigeria Limited down as XYZ private venture in, let's say, in Switzerland. So XYZ gave a loan of, let's say, $2 million to ABC Nigeria. You know, ABC Nigeria is also expected to pay interest on loan to XYZ PVT. Now, what the law is now saying here is that whatever interest that you are paying, whatever interest expense that you are paying to DCL, because you are a subsidiary to XYZ PVT, because you are a subsidiary, whatever interest expense that you are going to pay should not be more than 30% of your EBT, which is earnings before, okay, we call this one EBITDA, earning before interest, tax, then depreciation and amortization. So you should not, as in the interest that you are supposed to pay to this company should not be more than 30%. But in the event where the interest is more than 30% of your, where the total interest incurred is more than 30% of this your earning before interest, tax, and depreciation is more than 30%. So whatever excess that you have, you can carry it forward for additional 5 years. So if that interest is more than 5 years, it will be what? It will be written off. It means you need to write it off. So that is what we have here. Because that is if you have any connected person. But if you don't have connected person, whatever interest that you incurred, everything can be paid, everything can be allowed. But where you have that interest is just only 30% that will be allowed. So the excess interest can be carried forward for up to 5 years and allowed as a deduction in subsequent years, subject to the same restriction, which means it can still not be more than 30%. So this rule applies after complying with the income tax transfer pricing regulations. So what is a connected person? A connected person includes anyone controlled by or under common control, ownership, or management or a related party under transfer pricing regulations. So that is when you have any party under the same control that has to do with maybe subsidiaries, or it may even be an indirect subsidiaries, a direct subsidiary. So where you have all those parties, when you have all those companies under common control, under common ownership, or under common management, or they are also related under transfer pricing regulations, so they will be considered as connected person. Note, banking or insurance companies are generally excluded. So where you have banking or you have insurance business, so you definitely have different branches, different banks, and all those things. So, but if that Nigerian banks or insurance pay interest to a foreign subsidiary, a bank, ABC Nigeria Bank, is now paying interest to XYZ Canada Bank, but they are of the same, so they are of the same, they are under the same common control. Such bank will also need to restrict its own interest expense too. So we have one example here. So let us quickly deal with this example before we move forward. Let me copy it. Okay, so the example reads thus: Jones Nigeria Limited, a large organization, was incorporated on November 2, 2011, and it commenced operations on October 4, 2012. ABC Canada Limited, its subsidiary. ABC Canada Limited is its subsidiary in Canada. An extract of the financial statements of Jones Nigeria Limited for the year ended December 31st, 2024 revealed the following: accessible profits. So these are the accessible profits, right? But they are now saying that the interest and depreciation deducted before arriving at the accessible profits is this. They are as follows: interest on loan paid to other creditors, interest on loans paid to ABC Canada, then the depreciation. It was stated that out of the loan paid to other creditors, 200,000 naira was in respect of a loan obtained in generating tax exempt profit. So compute the interest deductible in the relevant year of assessment, then state how the excess interest not deductible in the relevant assessment year will be treated. So I extracted this from our ICANN part. So let us look at it together. Okay, let me just copy this. Okay, so this is the question here. You know, when we discussed about the interest deductibility, we said that the company cannot deduct more than 30%. That is provided there is, what's it called? Provided there is connected person there. So now let us look at this. What is our profits before? These are our accessible profits, right? We have accessible profits of 1 million. Then our EBIT. How do we now determine our EBIT? Our EBIT, our EBITDA. Our EBITDA is earnings before interest and tax and depreciation and amortization. So to get this now, what we need to have here is that we need to have our accessible profits to be added. These are accessible profits, 1 million. Then we need to add back. We add back. What do we add back? We add back the interests. We add back the interest from the what? From interest paid to Canada Limited. Interest paid to ABC Canada Limited, which is how much? 750,000. Then we also have depreciation. What's our depreciation? Our depreciation is also 300,000. And we also have these amounts. We also have this, you know, once to compute our adjusted profits here now for this. So we also have this 200,000 naira that was deducted before. Are you getting it now? This 200,000 naira was deducted before. It was also in respect of the loan that was obtained in generating tax exempt. And you know, we said any tax exempt generated, the expenses incurred on it will also need to be added back, right? Expense on income, on tax exempt income, which is 200,000. So what's the total profits now? What's the total adjusted profits? So this is 500,000. This one
2
050.
million.
What's the total answer?
2 million. 2,250,000.
250,000, right? So this is then, which means this is our what? This is our tax. This is our EBITDA. This is our EBITDA. Now, so now calculate 30% of this. So now calculate 30% of this. So what's going to be the 30%?
675,000.
30% of EBITDA.
$675,000.
This is 675,000, right?
Yeah.
So now, if this is 675,000, the total amount that we deducted initially was how much? 750,000. So if you now say that the excess interest, how much is that one? We have 750,000 minus 675. What's the answer?
75,000.
5,000.
What's the total? Sorry.
75,000.
75,000. So what it then means is that this 75,000 will be carried forward. Are you getting it now? So this 75,000 will be, sorry. There is a mix up here. Sorry. There is a mix up here. So what we are trying to ascertain here is not the adjusted profit, right? But rather, what we are trying to ascertain here is the excess, what's it called? Is the excess interest. So we are saying that the EBITDA that we have here, interest paid to Canada, interest paid to ABC Canada, 750, then depreciation to is this 700 and is 300,000. So the total will be what? This will be 2 million and what?
50,000.
2,050,000. So then what's now the 30%? 30% of EBITDA. So how much is that?
615,000.
615,000, right? Then what's the total interest? Total interest deducted. Total interest paid to ABC Canada. How much was that? 750,000, right? Then we are now saying that 30% of EBITDA. So we are saying whichever is lower is what we are going to pick, which is 615,000. So what's the difference? $135,000, right? So this 135,000 now, this 135,000 will be carried forward. Are you getting it now? So this 135,000 will be carried forward. So if you are now want, so if you now want to, if you are about to now calculate our adjusted profits. So what we can now have for our adjusted profits is that we have this for our adjusted profits now. So our adjusted profit is this, the total profit that we have, the total profits before accessible profits would be what? We have our accessible profit to be 1 million.
The 1 million.
Then we have the total. We have our accessible profit to be 1 million. Then we have our depreciation, right? Our depreciation. So this cannot even be our accessible profits. You know, when we are working on adjusted profit to arrive at our accessible profits, right? So what we now need to do here is that we have our depreciation of, so the one that we need to add back. So add back now. So what we need to add back, we add depreciation of 300,000 back. Then we also add our tax exempt interest on tax exempt profits, which is 200,000, right? Then we also add, what else? Excess interest, which is 135,000. So this is what we need to add back to our adjusted, to the profit that will be coming from our profit or loss. Are you getting it now? So this will be the profit that we need to, this will be the adjusted, the add back expenses or the add back profits that will need to be added to whatever item that is coming from our profit or loss. But what we only did here was to come up with our EBITDA, right? So because what we are saying here is that profit before interest and tax. Okay, so let us move on.
Hello.
Okay, I can hear you.
Yeah, the requirement is to compute the interest deductible in the
relevant years of assessment, and then state out the excess interest. So what you are asked to compute was just the interest that will be deductible in the relevant year of assessment. So the interest that will be deductible in the relevant year of assessment would be 300,000 from this. Are you getting it now? 300,000 naira from this. Then this 750,000 is not going to be, we are not going to take this 750,000 from this particular one. But what we are going to take here, will be 30% of our EBITDA, which is our profit before interest and tax. So if you are to, sorry, I think there is a mix-up here. Apologies.
I'm thinking there should be a proper, one thing with answering ICANN exam.
Okay.
They always have approach. They always have a proper approach to solving their questions. I was expecting something like that. You understand?
Okay. Hold on. Okay. I understand what you're saying. Okay, instead of us to just arrive at the answer, right?
Yes. There should be a standard approach so that we just go straight. This is a pattern you follow.
Okay.
But we just keep doing, we need to be careful with things like this.
Okay, I understand what you are saying. So now let's say, okay, so this is it now. What's the name of the company? Jones Nigeria Limited, right? Computation of interest deductible for 2025 year of assessments. Are you getting it now? So this is it here. Then we have this amount. So what's our accessible profits?
Hello, why 2025?
Okay, so look at the question. The question is 2024 financial year end.
Okay.
Do you understand now? Okay.
All right.
So we have accessible profits is 1 million. Then adjustments for EBITDA. Are you getting it now? Adjustment for EBITDA here. So we have interests to others. Interest to others was 500,000, right? Then we also have depreciation because it's also part of the EBITDA. Depreciation was how much? 300,000. Interest to Canada, to ABC Canada was 750,000. Are you getting it now? Then we need to deduct this tax exempt interest. So let us come up with this one first. So let us add all this one together. So what's the total for this? Eight hundred plus 750. 800 plus 750. What's the total? Eh?
1,550,000.
One what?
1,550,000.
1 million. 1,550,000. Sorry. So then we now have the interests because our total, what's it called? Our total interest that will be allowed for the adjustment for the EBITDA, right? Is not going to that 200,000 that is for tax exempt. We also need to be deducted less interest on tax exempt income, which is 200,000. So what do we have here? We have 1,350, isn't it?
Yes.
We have 1,3. So this is our interest before. This is our interest before tax now. This is our this is going to be our interest before, what's it called? Sorry, let me just give me 2 seconds, please. There's distraction. Hello, sorry, apologies. There was a bit of distraction here. So the total interest, so the total profit, it means these are profit before interest, right? Interest, taxation, interest tax, and depreciation. So if you add everything together, what is it going to give us? It's to give us 2,350. Am I right?
Yes, you're right.
Okay. So now, since this is our interest, our interest our restriction to interest is 30% of the interest, right? So now, what we now need to do here is that we now say 30% of EBITDA. How much is that?
705,000.
700 and what?
5,000.
No, 2,350.
705,000.
Okay, 705,000. Seven fifty, 300, 200 is 800. Okay, so 705,000. So, but the difference between the interest that was paid here, the difference between the interest that was paid between 750 and 705,000 is what will be carried forward for another years. So, which means the total amounts that the company can restrict, the total amounts that the company can deduct from its tax is 705,000, not 750,000, right? So that is what the interest deductibility, that is what is all about. Okay, so let us then state how the excess interest not deductible in the relevant year assessment will be treated. So the way to be treated is that it will be carried forward, so it can be carried forward for 5 years, which means the same restriction will also still be applied to the subsequent period. So that is what we have to do. Then for the rental charges in respect of residential accommodation occupied by employees of the company are allowed up to a maximum of 100% of the basic salary of employees. So what we are saying here is that if a company or if an entity pay for the rent that is occupied by the employees, so the total amount that could be deducted will be 100% of the basic salary of such employees. So invariably, if an employee is, let's say, 5 million naira as an accommodation fee, right, for the employees to occupy. So, in our normal basic salary, in our normal salary structure, we normally have basic housing, right? Basic housing and transport and some other payroll elements. So the only amount that will be allowed for deduction will only be restricted to the 100% of these amounts. It will be restricted to 100% of this amount. Then the repairs and renewals, the usual items under this heading are those expenses incurred in maintaining the earnings capacity. So what we are saying here is that for just normal repairs and maintenance expenses, not the one that will enhance the capacity. If on a normal day you just grease, you just do a normal repair that has to do with that does not have to do with the enhancing the capacity of that machine. So that is the one that could be allowed for the deduction. But I have also dwelled more on this at the earlier discussion. So what we are saying here is that any amount that is not meant for increasing the earning capacity of that machine could only be allowed for deduction. Any excess, if such expenses is incurred to enhance the capacity of that machine, it means it will need to be capitalized to the asset. Then we also have our bad and doubtful debts. So I've also explained this before. Our bad and doubtful debts could be allowable. Such bad and doubtful debts must be what it must be related to the ordinary course of business, and it must also be specific. So reserves no longer required are taxable than if previously allowed. So reserves are no longer required. So they are what they are taxable. So if you have, there is what you call uh there is what you call ECL, expected credit loss. So if you expected credit loss is also part of reserves, right? So we have what we normally take to reserve. We have some that we take to the reserves. So if at the end of the day that reserve is no longer allowed, that reserve is no longer required, rather, it means it will be what? It will be taxable. Then debt previously written off allowed in tax computation and later recover are taxable as income for the year. So if you have written off some debts in the past period or during the past years, and you are now able to recover it, so such amount that you recovered will be taxed. Then necessary evidence must be provided at the request of the revenue service to prove that the debts have become bad or estimated. So you need to show that you need to show to the revenue authority that you have tried to recover all the debts, you have tried to recover the debts by all means, but just that you are unable to do so. So you need to demonstrate it to them before they will allow you to deduct your bad debt as an allowable expenses. Then we also have what is known as the refund or a liability expense. So if a company has an expense that was originally allowed for tax purpose, but later that expense is waived, forgiven or refunded, the amount waived or refunded is counted as income for the company in the year it happens. So what we are saying here is that if in the past you have incurred some expense, let us take for instance that you purchase an item from me, maybe I render some service to you, let us say professional fee, professional service. mm. So when I render that service to you, and at the end of the day, maybe you did not pay that money, I just look at it that way. I don't think I may be able to get this money back from you. And I ask you to I ask you to leave the money, that there is no need that you can just that there is no need for you to pay back. So if the total amount was 300,000, in the year that you are computing your tax, let's say in 2024 that you are computing your tax, you must have already deducted this, Abi, as part of your liable expenses. But because I forgave you this amount, that you should leave it. So what we are now saying here is that in the subsequent year that this payment is allowed to be forgiven, what you need to do is that you need to consider it as an income. You need to consider it as an income. But when you are considering as an income, you will also charge tax on it. But if that amount that was waived is a non-expense item, for instance, maybe like a loan, you borrow the loan from someone and that person now waive that loan for you. So you not treat it as an income, right? Because you have not even deducted an expense on it before, because it was taken as a capital nature. So because it was taken as a capital nature, so what you now need to do is to so what you just need to charge on it will be capital gain tax, but it will not be computed under your income tax. You are not going to consider it as your income tax, but it will be considered as your capital gain tax. So in summary, waived or refunded expenses will be taxable income, while waived or non-expense liabilities like loans, so it will be considered as a capital gains tax. That's where we are going to deduct it. So below is the illustrative adjustment. Net profit per account. Net profit per account. So this will be coming from your statement of profit or loss. You add it here, then you add back the salariable expenses. You also add back income that is taxable, but you omitted it. That income is taxable, but it was mistakenly omitted. You also add it back. Then you less non-taxable income. So what are the example of our non-taxable income? We have, for instance, profits from disposal of PPE, your frank investments income. So you will need to deduct them from this. Then you have allowable expenses omitted. When you also have an allowable expenses that you have omitted, okay,
These allowable expenses, usually, most of the time, it's usually combinational information, because I know most organizations, there's no way they will have omitted allowable expenses.
Well, you are right, though. You are very, very correct. It's normally, so even all these ones that we are talking about here, all these ones, some of them might also still be part of the additional information.
Exactly.
Do you understand? So that's just it. Then we have the expenses incurred in deriving exempt income. Certain expenses cannot be deducted when calculating company's taxable profit. This include costs incurred to earn tax exempt income. Like I explained earlier, when you have expenses that you incur to derive your non-tax income, you need to deduct it. Then capital losses. So loss on fixed asset disposed. Then expenses already allowed under capital gain tax. So all these expenses will not be what? They will not be an allowable expenses. So, however, if an expense is used to generate both taxable and tax exempt income, only the portion related to taxable income is allowed as a deduction. Only that portion is allowed as a deduction. So that is all we have for today. So maybe in our next class on Wednesday, I'll come up with a question that we are going to solve, so that we can address all these items that we have listed here. Any question thus far? Any question? Any question? We still have like 15 minutes, like 30 minutes more. Any question, please?
No question for them.
Who else are on the call? Because it's just only your voice that I can hear. I have many people on the call. Okay.
Sometimes we are having network issues, so just keep going on.
Okay. So this is where we are going to stop for today, so that we can go and prepare for the class. So there is no need for us to meet by 6 p.m. again. Do you understand? Because I also want to use that one for something else. So let us just try, and I'll share the notes with you. Let us try and go through the notes, so that we can also prepare for the next class. And by the next class, I promise that I'll be coming with a comprehensive question that will enable us to address some of these provisions of the tax that we have here. So, okay, you wanted to say
No, finish.
something?
Finish first.
Yeah, that's all. That's all. That's just what I wanted to
Okay,
say.
we are hoping that you can come up with something that miraculously will see the question in the hall as well.
Don't worry. Don't worry. Don't worry. Don't worry. As don't
All
worry,
right.
I promise you, I'm going to come up with a comprehensive question, with a very, very comprehensive question.
Okay, we are hopeful that we'll
No
see something
problem.
similar.
No problem. I can guarantee. One thing is this. Let me also tell you something about ICANN. ICANN is not about you cramming everything. It's about you understanding the principle. Are you getting
Exactly.
my points now?
Yeah.
So when you understand the principle, and what are the principles? The principle is that, for instance, they gave you questions, and from the questions, you have some expenses. So from that expenses, you are now the one that will now, at least, if you understand the principle, okay, I have salariable expenses. The first thing that will come to your mind as salariable expenses is depreciation. That is a no-go area. That's number one thing. Are you getting my points now? Your depreciation is a no-go area. You add it, you add back, then all the other salariable expenses that you might likely have there. Are you getting my points now? All the salariable expenses that you might likely have there, you also bring it back. For instance, if you have a donation to political party, automatically you need to add it
It's
back.
alive.
If you have a donation to market women is not part of the listed item in our tax law, you add it back. If they also tell you that, okay, during the year, the entity disposed some assets and they made a profit, or maybe they just give you, even they can just say other income. Under other income, if you now go to your note to the account, they may now tell you that other income relates to, they can now tell you that maybe 30,000 naira relates to 30,000 naira from other income relates to the profit made from the disposal of property, plant, and equipment. Automatically, when you hear that one, profits from that one is,
They've already
eh,
given you
eh,
a link. Yeah.
you understand. So
You
it is just
understand?
try and understand the principle behind it. So you don't need,
It's
because
all right.
all the list that we have there, you can't cram everything. There is no way you
Definitely,
can.
they are much. Yeah.
There are much. So it's just for you to understand the basic, and then you understand the principle. So when you understand the principle, so the remaining one, before you know it, by the time you have 2 years, you have 3 years, you have 4 years, before you know it, you are already more than 60. So that's how you can. That's how, because we still have a long way to go.
We have a long way. We have too many
So
topics. All right.
we see, so that's why I just said, let me see how we can, at least, if you can be, at least that, what's it called, that Wednesday, if you can try and be punctual on Wednesday too. So
Okay.
I will see, at least before we know it, we'll definitely cover as much as possible. So
It's all
thank
right.
you. Okay, thank you very much.
Thank you.
And thank you for showing up today, at
Sorry,
least.
sir.
Okay, I'll go ahead.
When is the class? Are you going to share a different link or is this the same link?
Okay, what I'm going to do is that I will, because I noticed that because we've not been sharing the link every time, maybe people tend to
Mm.
forget, or maybe people does not even understand how to go and click on that pin message. So maybe every class I'll be sharing it with us, so that once we see the link, that one can even prompt us that the class is about to commence.
Yes, it's
Yes,
better that
because
way.
I
Okay.
don't know that there's Wednesday class.
So I think, because I know that was what happened last class, that I waited
Mm.
for 30 minutes and nobody joined. Do you understand? So
Oh,
that's what
I
I'll be
myself
okay.
doing
didn't know
now.
the class was on then that day.
So I'll be sharing the link. So the link is the same, but anytime you want to add the class, I'll be sharing the link with us. Maybe like
Oh,
10 or 15 minutes to the class. I'll be sharing it so that it can also prompt every other people that the class is currently going on.
all right.
All
It's all
right,
right.
no problem.
Yeah, yeah. Thank you. Thank you for your time.
Thank you very much.
All right, thank you.
Okay, yeah, bye.
Thank you so much. You are great, sir.